Let's talk about money and making good financial decisions in your life. Whether you're a newcomer to Canada or just starting to dive into all things finance, this video will cover all you need to know about TFSA and RRSP accounts in Canada. We will discuss the benefits of each account, the difference between the two, and how you can maximize their benefits. Let's go. A tax-free savings account is simply a savings account that allows Canadian residents to earn tax-free investment income. Overall in Canada, you have to pay tax on any kind of income. Investment income or interest income is no exception. It is subject to capital gain tax, and the purpose of TFSA account is to shelter you from that tax. Any Canadian resident 18 years old or older who has a valid SIN number can open a TFSA account for free. If you are a Canadian resident but do not have a TFSA account yet, please leave a comment below and let me know what's been preventing you from setting it up. So how does TFSA work? Contributions to a TFSA are not tax deductible, which means that you can earn your salary, pay tax on it, and put money in TFSA. But any income earned while the money is in that account, including interest, dividends, capital gains, is not subject to taxes. TFSA account is also flexible, so you can withdraw money from your TFSA account at any time for any reason without paying any taxes on your withdrawals. So let's say you have $10,000 in your regular investment account and you decide to invest into the stock market, and you go through a very successful year, make some trades, and end up with $11,000 in your account thanks to the stocks going up. Normally, you'd be required to pay capital gains tax on the 50% of $1,000 you have made, or $500. That's how the capital gain tax works. It taxes you on half of that gain. $500 is then added to your total personal income in that year and is taxed according to your tax bracket. If you hold your investments in the TFSA account, with all else being similar, you will not pay any tax on that $1,000, as long as that investment income is generated through your TFSA account. The TFSA was introduced in Canada in 2009, and since then it has become a popular way for Canadians to save for their future. Contributions to a TFSA are limited by the government, and these limits are adjusted each year. For instance, the annual TFSA contribution limit for 2023 is $6,500. This means that you can contribute up to $6,500 to your TFSA in 2023. Any unused contribution room can be carried forward to the future years, so the following year you can put a larger amount of money in that account. The yearly countdown for contribution rooms started from its inception in 2009. So if you've been in Canada since 2009 and were 18 years or more in that year, you will have had roughly $5,000 or more of contribution room consistently added to you each year. Since its inception, each Canadian in 2023 has accumulated $88,000 of contribution room. That's regardless of whether or not you had the account open. If you open the account today, you will be able to add as much as you want within the given year until you max out $88,000. So let's take a newcomer scenario, for example. If you're a newcomer to Canada and have been in Canada for, let's say, 3 years, like Anna, for instance, and you decide to start making contributions to your TFSA account in 2023, that's how much you can put in this year if you have that amount of money. And next year, your contribution room will increase again by the new amount, which usually revolves around $5,000 or $6,000. But what happens if you exceed your contribution room for any reason? At any time in the year, if you contribute more than your available TFSA contribution room, you will have to pay a tax equal to 1% of the highest excess TFSA amount in the month, for each month that the excess amount stays in your account. So if you do end up in a situation like this, just transfer the money out and make sure you stick to your contribution limit every year. You can always check your contribution room on the CRA website in your personal account. So why should you have a TFSA account? One of the key benefits of this account is that it allows you to save money for a variety of goals, such as saving for a down payment or a house or a car or a vacation. TFSA also provides flexibility because you can withdraw money from your account at any time without penalty. This makes it a good choice for emergency savings or for short-term goals. RRSP is a registered retirement savings plan, and it's a tax-deferred savings plan that is designed to help Canadians save for retirement. Contributions to an RRSP are tax-deductible, which means that you can claim a tax credit for the money you contribute to RRSP in every single year. This can help you reduce your taxable income and save you money on your taxes. More on that in a moment. Opening an RRSP account is also free. Any Canadian resident that has employment income and files a tax return with the Canadian Revenue Agency and are not yet 71 years old are eligible to open an RRSP account. For instance, if you're making $100,000 in a given year in Ontario, your average tax rate will be around 27%, meaning that you're paying around $27,000 in tax. If you decide to make contributions to your RRSP account within that same year, let's say you decide to put $20,000 in the RRSP, this amount is deducted from your total taxable income, so your taxable income becomes $80,000 after the RRSP contribution. This event lowers your average tax rate to 25.5%. In this case, your expected tax paid is just above $20,000. This means that putting $20,000 aside in your RRSP delays the income tax you pay on that portion of income to the future and lowers your current tax paid, so you get a nice tax refund from the government in the following year when you do your taxes. The money you put into such an account is the money you're not supposed to withdraw until your retirement, which is currently set to 65 years old. So once you reach your retirement age, you can start withdrawing money from your RRSP. But since you're a retired person now and have lower income overall, the tax you pay on money withdrawn will be lower too. Just like the TFSA account, RRSP account also has its own contribution limits, but it's calculated differently. The amount which you can contribute to RRSP depends on your annual income. It's 18% of your previous year's income up to a maximum set by the CRA in the given year. In 2023, that limit is set to $30,780. Let's say you'd made $100,000 last year. That means that your contribution room for RRSP this year is $18,000, 18%. If your income goes up to $130,000 next year, then your following year contribution room will increase by $23,400, and so on and so forth. Any unused contribution room can be carried forward to future years, similarly to how TFSA works. What this means for newcomers is you must have worked and filed your annual tax report first in order to be able to open an RRSP account, and then you'll be able to start contributing to it the following year. The money you contribute to your RRSP can be invested, and the returns in these investments can also help you grow your savings over time. This can be your additional source of income outside your pension when you stop working and enter retirement. I'm curious, how many of you guys are planning to buy a home soon? Let me know in the comments below when and where you're planning to make this big purchase. Another benefit of RRSP is a first-time home buyer program that is essentially an additional source of savings for your down payment to buy your first home. Under the Home Buyers Plan, you can withdraw up to $35,000 tax-free from your RRSP account to help finance the purchase of your first home. If you withdraw an amount higher than that, you will be taxed on that as personal income. Once you withdraw the money from your RRSP, however, under the HBP, that amount must be repaid to your RRSP over the period of the next 15 years. So what's the main difference between the two, the RRSP and the TFSA? The way I look at it, TFSA is a shorter-term savings account. It's liquid. I can deposit and withdraw money at any point in time without any penalties. RRSP, on the other hand, is a long-term savings account. When you deposit your money into RRSP, you're not expected to touch it until you retire or buy a home. The TFSA contributions have no tax implications, but it's sheltered from the tax on the gains generated while the money sits in that account, while RRSP helps you reduce your taxable income. So should you open any of these accounts? Absolutely yes, you should open both TFSA and RRSP account and start contributing to them as soon as you can. Opening these accounts is absolutely free. You can do it in any bank. If you're looking to reduce your taxable income in any given period and don't have a burning need in money, RRSP is something you should definitely prioritize first. Even if you're not looking to reduce your taxable income, but want to build a comfortable financial future for your retirement, our recommended plan of action is to open up an RRSP account, set up an investment account within it, and buy some index funds and see your wealth grow over the years. There are companies and banks that can help you manage your investments inside RRSP for a small fee if you're uncomfortable making investments yourself. It's totally worth it. This is passive income money will be making money while you sleep. And one day you wake up and see a nice sum accumulated in your RRSP to provide you with comfortable retirement. TFSA is great for savings and investing. You can have an interest-based TFSA account open where you just earn interest on your deposits. You put money in there and you forget about it. Or you can open an investment account within the TFSA account, in which you can purchase stocks or ETFs or things like that. You will not be taxed on the returns made in this account and will be able to withdraw the money at any point in time if something happens, like emergencies. TFSAs provide a great level of flexibility here. There is absolutely no reason not to open it today and start using it, even if you're making the tiniest deposits of $5 a month. Now, with all of that information in mind, what's the next step for you? If you're ready to open a TFSA or an RRSP account, we'd personally recommend starting with Wealthsimple. It's an investment management service that makes it super easy for a novice investor to set everything up. You can set up an investment account with both TFSA and RRSP and start saving and investing on your own terms. My favorite thing about Wealthsimple is this really cool feature called the Roundup feature. With that feature, you connect your credit card to the app, and then with every purchase you make with your credit card, your transaction will be rounded up to the nearest dollar, and that round-up amount will go into your savings account automatically on a weekly basis. It's the easiest way to start saving, and you'll even barely notice it happening. You can check the description box below for a unique referral link. If you use it, you will receive your first stock for free. Thanks a lot for watching, and if it was helpful for you, please tap the like button below to express your gratitude and subscribe to our channel for more videos like this. Let us know in the comments below if you have further questions, and happy investing, guys! See you later!